So, financial assets. 1. Norman has the following financial assets during the financial year. 1. Norman bought 100,000 shares in a listed entity on 1st November 2015. Each share cost $5 to purchase and a fee of 0.25 per share was paid as commission to a broker. The fair value of each share at 31st December was okay, so what do we do? Norman bought into the financial assets. Into how do you recognize this? Should you recognize it through OCI or you recognize it through P&L? There is no statement that tells us that. But by default, we will recognize it through what? P&L. Are you getting the idea? If the examiner is silent, the default approach is that you recognize it through OCI. So, hey, I said OCI. Not P&L, not OCI. That's an error. So, 1. Recognize financial assets at what? Fair value through profit and what? Loss, or through the income statement. What does that mean? It means the issue cost or the transaction cost will be what? Written off. So let's go. How much do we have at the date of acquisition?
How much do we have as in what? The fair
Like
value.
what would be the fair value?
The 3.5 times 100,000.
So 3.5 times 100,000. What do I have?
350,000.
315, 1, 2, 3. Okay.
350.
So, right. So double entry
50.
50. Okay. Double entry. Debit financial assets or investments in your books. That goes to BS. 350,000. And then you credit what? Cash or bank. 350,000. Then the transaction cost.
The transaction cost will be the
0.25 times 100,000.
Yeah.
And that gives us, you said it to be how much?
I'm coming.
Okay.
25,000.
25,000. So what do we do? Since we are recognizing it through profit or loss, the transaction cost is what? Written off. So we debit the income statement or P&L with 25,000 and then credit cash or bank with 25,000. Make sense?
Yeah.
But at the end of the year,
Is the 0.25 included in the 3.5?
how? Why are you asking that? Hey, did we buy the shares at 3.5? You gave me a wrong answer. We bought it at $5. So.
Each share costs
You
5.
asked for fair value.
The 3.5 is at the end of the year.
Oh.
But at acquisition, how much did we pay?
Okay, sorry.
Do you get it?
Yeah.
Yeah. So would it be included in the 5?
No, why will you include it? It's not included. The transaction cost is always different from the share price. Are you getting it?
Okay.
So it should be $5. So that will be what? 500,000. So we debit 500,000. Credit 500,000. Are you okay? So this is once at acquisition. And that date was what? 1st November 2015. So as at 31st December 2015, that is the year end. What is happening there? What is happening there?
Valuation.
So the fair value now is 3.5 times what? 100,000. Into 9, and I'm going 350. No?
Yeah.
Into what has happened?
A loss.
A loss. So that loss, because we are recognizing through P&L, that loss will be recognized where? In the income statement. So what's the loss? 150,000. So fall in value. 500,000 minus 350,000, and that's 150,000. Double entry. It debits the income statement because it's an expense, 150,000, and credit the financial Elia has a day. The financial asset or the investment, 150,000. Are you getting it? So this is the entry. This is the entry for the first one. So let's go to the second one, and I leave it to right. So stay with me. Norman bought 200,000 shares in a listed entity on 1st March for $500,000, incurring transaction cost of 40,000. How come two different currencies are here? 40,000 euros. Because it should be dollars all throughout. Norman acquired the shares as part of a long-term strategy to realize the gain in the future. As part of a long-term strategy. What does that tell you?
So what? Norman acquired a share.
Yeah.
As part of a long-term strategy.
That means he's holding the share to
maturity
sell, yeah.
or to sell in the future. For that reason, how do we recognize it? Through profit or loss or through OCI?
OCI.
Through OCI.
Why?
It will become you get.
Why is it other comprehensive income?
You gain on the.
Because any gain here, because they are holding it for a long term, any gain would have to be treated in the other comprehensive income, and will have to be added to the value of the shares. I getting it? Any gain or loss will be treated. So if the statement in this one there was no statement like that, that's why we treated it through what? P&L. But if it's for long-term investment purposes, then they can't what? Hold it out during the year. So it means here the transaction cost will not be written off, but rather will be what? Added to the.
Because it's long term, that's why it goes.
Yes, because of the statement. That's why we are taking it to the OCI.
Okay.
Then it says.
It could be possible that the long-term strategy could result in a loss.
Yeah, there is gain or loss. But the main thing is that now it means the transaction cost will not be what? Written off, but will be what? Included. I hope you're getting the idea.
Yeah.
Okay. The fair value of the shares was 640,000 at 31st December. The shares were subsequently sold for 650,000 on 31st January 2016. So on 1st March 2015, we bought the thing. So how much did we pay? 500,000, isn't it? Yeah. So we debit financial asset or investment of the 500,000 and credit what? Cash. 500,000. Then the issue cost. What do we deal with it? So this is fair value through OCI. Alright? So the issue cost, which is how much? 40,000. Can you see that?
Yeah.
40,000. So we debit financial assets with the 40,000 and credit it as a cash 40,000. Please get a difference. Get a difference. Also, issue cost or transaction cost, they call income statement. You're writing it off because it was for trading purposes. But because we are holding it to maturity, we must add it to the financial asset. So now, as at the 31st March 2015, the initial recognition of the financial asset is going to be what? The 500,000 plus the 40,000. And that will be 540. 40,000. That's what we are talking about. Now look at it. It says, as at 31st December, then they buy.
The fair value of the shares
Is now how much?
620.
620,000. So now fair value of the shares is 620. Then they also increase of how much?
80,000.
80,000. So there is a gain in fair value, which is 620,000 minus 540,000, and that is what's it? 80,000. You see, if it is carried through OCI, you carry it through OCI. So double entry. You debit the financial assets with the 80,000 and credit what? Gain
OCI.
Gain on financial assets, and that goes to the OCI. How much? 80,000. Does it make sense?
Mm-hmm.
Now, what does that mean then? It means at the end of the year, in our balance sheet or in our statement of financial position, the value of this financial asset and the non-current asset is how much? 620. Then we come to equity. Under equity and the reserves, there will be reserves from the financial asset, and that will be what? 80,000. Does it make sense? So maybe I call OCI Mubia, a call into statement of changes in equity. Now a call into equity.
Okay.
Are you getting the idea? It's because this is a gain on an investment, it will go to OCI and it will go to reserves in the balance sheet. Then they buy on 31st January.
So sold for 650.
Into Shadia. Disposal of the shares. How much? 650. Shadia. BBC. As at 31st December, no shares ne
620.
buy a ton
650.
This is gain on what? Disposal. What did I tell you about gain on disposal?
You take it to the
Income statement. So here there is going to be gain on disposal of 650,000 minus 620,000, and that is 30,000. So what is the double entry for this 30,000? Oh, my space is even exhausted. Okay, you finish writing and let me do that here. I don't want to squeeze the thing here. But please, do you understand up to this point?
Why did you say that gain on disposal goes to income statement?
I said that. Didn't you write? That was the statement you asked me to rewrite.
Okay.
So,
and then
yes, after gross profit, gain on disposal. Do you have it there? And now you don't have it there after.
I think you said it's casual.
Okay. Okay. So please write now, and I don't want to squeeze the presentation there and make it nasty. I want to make it a bit nice. So double entry for our disposal. How much did we get? So we debit, the proceeds. 650, right? So we debit our cash book, 650. Then we credit the financial assets, which is our investment. Our financial asset is now having how much there?
620.
620. So we credit it with the 620 and take it out. So the balancing figure,
30.
NMI again now, we say we will credit what? The income statement with the 30,000. Does it make sense? So that is what I was saying, that the gain will be taken to the income statement. So you see that what I did here is what I have redone here. It's what I have redone here. Now, what happens to this figure? To this gain? What happened to it?
What happened to it?
Yes.
The 80,000.
Yes.
You add up to your equity.
No, your ton shares no equity. So what happens is that the reserve, gain on the reserve will be taken from the reserve and put into what? Retained earnings and paid out as dividend in the statement of changes in equity.
This one is gain in fair value.
Yeah, gain in fair value. And I are called under equity as reserves. In sense, what tons assets no Any hobby, asset in hobby. It says so changes our reserve into what? Retained earnings in the statement of changes in equity. So that is the treatment for that. So the gain on fair value 80,000 is transferred to retained earnings in statement of changes in equity. That's it. Say I disposing.
Sir, 80,000.
There be a ton of shares now. Equity gain.
Okay.
It says I say free up.
Okay.
Now they call retained earnings.
Oh, okay.
That's the idea. So that's the last question on the Norman.